perception, and we're what is core changing is versus opportunistic. Is there are people just going to go to the U.S. and for safe harbor, or are they going to go further out on the risk curve and continue going global?
I wish I had the answers to that. I see the investor community seems to be divided between those who are definitely sort of in a risk-off kind of mode, and in real estate, obviously, that's going to result in more core and core plus investments. And then the other group who seems more comfortable saying think that those strategies may in fact be fully priced or perhaps overpriced, and they're more comfortable with value-add, opportunistic investments, where in fact the risk may be totally mispriced. And I think the Wall Street Journal this morning was talking about the apparent appetite of investors at this point for more risky assets. Personally, it's something that I don't quite see. I see too much risk out there right now. I see people getting comfortable with more risk in their portfolios at a time that the macroeconomics simply don't justify it.
Yeah, I agree with that. And Rob, just going back to your earlier comment, you're dismantling one of the legendary legacy portfolios in the fund management industry at AIG. It seems that you're doing the rebooting, the restructuring, the repairing. There's just a massive amount of underwater real estate in that portfolio. So when you went out to market, were investors looking at this as just tremendous opportunistic kind of investing, or were they looking at it as you were historically, or AIG was historically, as it's like core plus with a mixture of development deals and opportunity? What I guess after 2 years, what's the message from this consolidation play that's been going on that you've been a part of, and how are they? What are some of the lessons learned going forward from your disillusion there?
Well, I mean, I think from the perspective of AIG and value maximization, as you go through that process, it's sort of pick up sticks. You have to do it one piece at a time. I think right before I came on board, they attempted some wholesale transactions for the entire platform, which really didn't go anywhere because of the complexity. And I think it was really part of the task is kind of developing a strategic plan for the portfolio and identifying those things you want to hold on to that have, ironically, probably the two largest pockets of value in the portfolio are a major mixed-use development project that we're in the midst of in Seoul, South Korea, and a merchant build platform we have with Lincoln in Eastern Europe that you're very familiar with. And so
right.
Part of it was, as risky as those sound, looking at where those were and the potential value creation, we sort of focused on trying to maintain those and not dismantle or liquidate or exit those, and then sort of went through the rest of the portfolio piece by piece, trying to clean up something and get it to be as close to core as possible before you go to market. So we have a multifamily asset that's got some lease up, that's got some partner issues, some debt issues. We go through it piece by piece and try to get as much of that resolved as we can so that we can hire an East Still or a Marcus and Millichap or one of the HFF to go out and run an auction. And today, even a B or even B- multifamily project in a good coastal market will get treated as an A asset from the bidder perspective in terms of a couple of hundred CAs, 20, 30 bids, a couple of best and finals. So it feels very vibrant, very core-like from a sale perspective. So the trick is, as you unravel it, as best you can to try to position the assets so that you can, so that the market will read them that way. So the market
Right.
won't read you as a group in distress.
Yeah, and that's interesting. Back in my G Capital days in Central Europe and Russia, when I was competing head-to-head with AIG Lincoln on office, our golden rule for pricing, returns was we'll take the sovereign debt rate and just add 1,000 basis points to it, and maybe another couple hundred for development or particular asset class, and down the line. I'm just curious. So how is market price? How are we pricing risk these days vis-a-vis the capital flows that are coming into the country or out of? I know, George, you're involved with a lot of money coming in here. So how do how do foreigners now view the U.S., and what's the risk premium coming into the U.S.? What are you telling them? What's the downside? What's the upside? How do you balance that?
Well, Ken, I guess one thing I would say is, given this, MIT they're very international students, and we talk a lot about, the Great Recession and all the problems in these hand-wringings. But let's stand back a little bit and talk about some of the larger macro trends related to this question you asked. If I look back at 10 years ago, nobody knew the word sovereign wealth fund. Today, this is emerging as a dominant source of capital. And if you're in Europe, Norges, Norway, tremendous, I forget the number now in euros, something like 580 billion. And it was just last year that their parliament approved going into real estate. They can't keep up with getting to a 5% allocation in real estate. And that money hasn't started yet. Even Ireland, which of course is in the straits at the moment, but their NAMA, which they created 10 years ago, one aspect of it is similar to the Social Security system here in the U.S. $20–30 billion. They're now using those monies to bail out the banks, but ultimately the system they've designed will generate a lot of public capital that'll be looking for a home in real estate globally. Asia, we know the situation there. The Americans are in debt to them, and they have a lot of treasury bills that are going to diversify into real estate and already are diversifying into it. We've certainly seen it in our portfolios where we've begun investing for them. And the Middle East, despite the issues that are going on across MENA, there still are large, very, very large sovereign wealth funds. So we have been working with them, and they're really not quite there yet. Some of them have made investments in the U.S. We have this issue here called FIRPTA, which is basically a tax issue which prevents even some of the sovereign wealths from investing in the U.S., although some of them I think are, when you talk about the prime core real estate and the low cap rate, these could be very, very long-term holders, so maybe they're not worried about the tax consequences if they hold this real estate for 20 or 30 years. It becomes de minimis in terms of affecting the returns. So I look at that, and I look at what our activity has been just in the last 2 or 3 years, and we're seeing a tremendous rise in that capital. But a lot of it right now is directed to Europe. We've seen more investments in London, Paris, even Germany, which I would say is not quite.
So core office and core office stabilized.
Absolutely. And you look at the cap rates and you say, well, it's beginning to approximate a bond, but you've got the saving is you're protected from inflation to a certain degree, and they're buying the very best of the very best. So we've been doing that, and I think that if the issue is, gee, this is just sort of a blip on the screen with this rush to core and it's going to back off, I don't think so.
Interesting. So Mark, you had mentioned that you're doing, you're going after, distressed debt plays. Who are the investors in that, and what are their yield expectations in this market?
The yield expectations of the investors are still 16 to 18%. Whether you believe it's achievable, that's what people are expecting. The investor is extremely broad-based. I mean, if you look at our client base, it's pension funds, endowments, sovereign wealth funds. It's all over the map. And then if you look at who we compete with, we can compete with local operators, private REITs, syndicators, REITs themselves, publicly traded REITs. We're now competing with hedge funds. And where we didn't have it in the early 90s, you now have debt funds who are looking at 8 to call it 10% yields to their investors, buying non-performing loan portfolios or sub-performing loan portfolios. So, there is a wide variety of sources of capital out there that we're competing against.
Kevin, you sit around a global institutional table at Pru, and you guys read the tea leaves from a variety of markets. How how does the U.S., fare to some of these other, like the EU markets in Asia and sort of attracting or competing for investors' appetite for, either, the core and core plus versus the more, outsized returns from opportunistic investment?
Interestingly, foreign investors backed off of the sophisticated foreign investors, mostly European institutions, backed off the U.S. market before U.S. institutions did. Alternatively, they saw when we were fighting fires here an opportunity maybe before we did. So our experience has been that they are generally enthused about investing here and see it as a good time in the in the overall cycle. Obviously, it's not at the bottom anymore. Values have rebounded pretty sharply for core assets. But I do think, we think we're going to see kind of a continued flow of international capital. They have such, as George mentioned, so many of them have such an investment problem that they can't really achieve their objectives without going to the biggest market for commercial real estate investment in the world, which is the United States.
So in your office portfolio, are you seeing real NOI growth in this year and next?
In the U.S.?
Yeah.
It's going to be pretty flat. I mean, you see tremendous growth in apartment income, in hotel income, but the growth in office, retail, and industrial, again, across the whole country, is going to be much more dependent upon job growth,
Right.
and that's
Still not happening.
people are definitely buying on the come there, and it hasn't evidenced itself to any great degree, even in markets where everybody feels good about things.
Yep.
New York, Boston, Washington, it really hasn't gotten there yet.
I mean, we have over 25,000, a shade over 25,000 residential units in 19 states, and mostly core plus, and we're looking at things that are really trading at that sort of pre-08 levels, and 4.5 caps with, and we're looking at 2-3 years of negative NOI growth, and we're just scratching our head. It's like, you got to say, did anybody learn anything? I mean, and that's why I get to this bubble notion that it's just kind of heating up again while the low rates are here, and just another 2 years out, there's just going to be another one of these like correction features that is out there on the horizon. Peter, you have a...
Yeah, doesn't that sort of, what you just said, kind of explain it? We learned not to project these growth rates into the NOIs, but on the other hand, if you buy something now at perhaps a slightly inflated price, but you can lock in that low-cost financing for 7 or 10 years, you may have an advantage going forward. So this could be a case where you're breaking one of the rules that you purposely set up, but it might be the right thing to do.
Are you feeling like the luckiest guy in the world having sold your Japan portfolio?
I'd probably be over there with my hazmat suit right now. So we closed on December 31st, and it was about 35 or 40% of the organization of $8 billion of assets, about 100 people, not just Japan but also throughout Asia. So I'm thankful. I mean, look, I feel, I work very closely with the folks over there. I sort of feel for them and everything that's going on in Japan, but I'm certainly happy that we're not having to deal with it on a day-to-day basis.
Let's stick on
business
that,
perspective.
on the Japan
Yeah,
notion. How
yeah.
has it kind of, affected the price of tea in Japan or China or that region? What kind of shock waves are you all feeling?
I mean, everybody I talk to, in Japan, it's obviously going to be serious, and I think have a long-term impact on the economic outlook. I don't think there's any question about that. The issues, I think, around the region, and as I talk to people around the region, first of all, for the people who are, within a certain proximity, whether you're in Shanghai or Seoul, you do look at the prevailing wind patterns, and you do look at what's going on with the reactor there and what's going to happen. So there is some residual, environmental fear in the region for those cities and regions that are close enough to potentially get affected. But that aside, take the immediate environmental impact aside, it's too early to tell. I mean, the forces going on in China are so, so powerful